Hi, this is Evan Hutcheson, and I'm going to go over the basic 1040 tax return. I will just kind of go over a grand overview of these 2 pages of this 1040. I'm not going to go over the other schedules and forms. This is the form that everything flows into. So no matter what, you're going to have to file a Form 1040 if you're filing a U.S. income tax return. You might not have to file any more schedules or forms, but everything that you do file flows into this form right here. So it's 2 pages long, as I said. This is kind of what it looks like. And the final numbers are right here. You're either going to get a refund or you're going to owe. And that's what all this is about. So if we start at the top, we'll put your name, John Doe, and your social right here. John Doe does not have a spouse. He lives on 123 Main Street. He has no dependents. If he had a spouse, it would go right here. If he had dependents, it would go right here, and that would increase his exemptions. So it's just him, so he just has one personal exemption. And we'll get to that in just a second. The next portion of the return is the income portion. Now, there are many different kinds of income that needs to be reported on your income tax return. One of the main ones, and one of the ones that a lot of people are only familiar with, is the W-2 income. Some people just get a W-2, and they're used to just filing it and getting a refund because usually there's enough federal income tax being withheld to cover their wages. Now, if you have a W-2, box 1 would go right here, and your federal income tax withholdings, I think it's box 3, would go down here on page 2, federal income tax withheld from forms W-2, right here. Then you have taxable interest, tax exempt interest. Some interest is not taxable by the federal government. If it's not taxable, it would go in line 8B. If it is taxable, or whether or not it's taxable, actually, it'll go in 8A. But if it is taxable, it'll go in 8A. If it's not taxable, it'll go in 8B. Same thing with dividends. You have to pay taxes on the dividends that you earn. If you have qualified dividends, they get a preferential tax rate of either 0% or 15%, depending on your normal tax rate. Your qualified dividends would go right there on line 9B, but they would also go on line 9A. Some other sources, I'll just kind of hit the main ones, to my knowledge at least, the ones that I run into the most. Alimony received. If you get alimony, it is taxable. If you pay out alimony, it's tax deductible. So if you pay it out, you can put it right here. And of course, they're going to want who you pay it to's social security number so they can look at that person's return and make sure they're claiming it as income right here. Business income would go right here. This is if you're a single member LLC or a sole proprietor. You would put your earnings and your deductions on Schedule C, which flows to this line 12 of the 1040. Now, if you do have Schedule C income, or if you have partnership income down here on line 17, you have to pay self-employment tax. Basically, if you get a W-2, you're already paying it out. You're already paying the employee portion out on your W-2. If you look at it, you'll see Social Security wages and Medicare wages, and those taxes being withheld. Since you don't get a W-2 and you don't make those payments in automatically by your employer, you have to pay it all on your tax return. And not only do you have to pay the employee portion, you have to pay the employer too. So if you look at a W-2, you'll see that the employee portion, the amounts being withheld, are 6.2% of your Social Security and 1.45% of your Medicare. Now, if you're a Schedule C employee or a sole proprietor, you put your income on line 12, your self-employment tax will not only be that 6.2 and 1.45, but it'll be the employer's portion too, which is another 6.2 and 1.45. So if you add up 6.2 plus 6.2 plus 1.45 plus 1.45, that'll total 15.3%. And you'll see 15.3% of your earnings down here on self-employment tax, line 56. Now you can't just take 23,192 and multiply it by 15.3%. You have to first take out the employer portion of the payroll tax, because you get a deduction for that. So you take that out, then you multiply that product by the 15.3%, and you get the self-employment tax down there on line 56. Now the deduction doesn't show up on your Schedule C. Instead, it shows up down here on line 27, deductible part of self-employment tax. Now remember, this will occur also if you have a partnership K1 that flows through to your 1040 income tax return. Okay, next in line, the capital gains or losses. You cannot deduct, if you have a capital gain loss, you can only deduct a portion of it per year. The remaining has to be carried forward. It's either $1,500 or $3,000 depending on how you file. If you have a gain, of course, they're going to want you to report it all. Now, if the gain's long term, you get a preferential rate, just like if you had qualified dividends. So you can be taxed on a long-term capital gain of either 0% or 15%. If it's short-term capital gain, if you held it for less than a year, then it is taxed at your normal tax rate. You have other gains or losses on line 14. So if you sell like a business asset from your Schedule C sole proprietorship, you would put the gain from that sale on line 14. IRA distributions, pensions, and annuities. You have to pay taxes on the distributions you receive from your IRAs and your pensions. Line 17, rental real estate royalties, partnerships, S corps, and trusts. Those go on Schedule E, which flows through to this line 17. Now, if you have a rental real estate activity, that's if you own some property and somebody's paying you rent for living there. You have to report the gain, but if you make a loss, if you have a loss on that rental activity, you might not be able to deduct it. Usually you can't, but there are some ways that you can. If you actively participate in the rental activity, if you're collecting the rent, if you're making all the payments to repairmen and whatnot, if you're actively participating and your modified adjusted gross income is less than $100,000, you can deduct up to $25,000 of the loss. But if you make more than that's when the amount you can deduct completely phases out. Then you won't be able to report any of the losses because it's passive loss. So theoretically, you can't ever report it except if it's to offset passive income. Then you have the farm income, or I'm sorry, I guess I'll go over the royalties, partnerships, S corps, and trusts. So these partnerships, S corps, and trusts, they come from other tax returns, and they're all flow through taxes. So what that means is when you file these other tax returns, you'll be filing a K1 on those returns. That K1 is for a specific shareholder for the S corp, or partner for the partnership, or a beneficiary for the trust. And when that person files his or her income tax return, he or she has to include that K1 on their tax return. So if they include a K1 from a partnership that makes a lot of money, that K1's, their portion of the income is going to flow through to line 17. If you have a farm and you sell livestock, or you sell agriculture or whatever, then you have to fill out a form. I think it's 4835, and that flows through to line 18. If you make unemployment compensation during the year, you have to report that. Social Security benefits, you have to report that income too, and it'll be taxable depending on your income. So you might not be liable for much, if any, of the Social Security tax, and you might be liable for all of it. The full amount you put on line 20A, the taxable amount you put on line 20B. Then you have other income, Other income could be an assortment of things. It could be a wide range of things. It's just the items of income that you need to report that are not prevalent enough to have its own line item. So if you go to the casino and win $20,000, you would record that on line 21. And usually the casino will send you a W-2G, which will report that income to both you and the IRS. So if you try not to report it, the IRS might come after you because they will see that you should be reporting it. So that's pretty much a quick summary of all the income. You put all your income up here, and then you subtotal it right here. So John Doe's got $78,393 of income. Then you come down here. There's educator expenses. If you're a K through 12 school teacher, you can deduct up to $250 of your unreimbursed supplies that you pay for school right here. If you are in an HSA, you can make deductions for contributions to the HSA up to a certain limit, and you can put those deductions here. Now, everything that I say it depends on something. Everything has so many variables involved. So if you have an HSA with an employer, for instance, that employer is probably already taking it out of your W-2 income, so you want to be reporting it right here. So take everything I say with a grain of salt. But for the most part, this should help you just understand what's going on here with this tax return. Moving expenses, if you move for work, maybe more than 50 miles away, then you can deduct moving expenses. That includes U-Haul, transportation costs, your lodging, your meals, everything involved in the move, basically. We already kind of ran over this deductible part of self-employment tax. The SEP and Simple and the IRA deduction right here. These are both kind of the same thing. They're retirement plans that if you contribute to, you can deduct. This is a traditional IRA. It's not a Roth because a Roth IRA is not deductible when you make contributions. You can have a SEP if you have a self-employed business. It's a self-employed plan for retirement, and you can deduct your contributions. Self-employed health insurance, same thing. If you're self-employed, you can deduct your health insurance right there on the return. If you're not self-employed, you can deduct it if you itemize deductions and you utilize your medical expense deduction, but that's for another tutorial. Let's see, student loan interest. You can deduct interest you paid during the year up to a certain limit for student loans. Tuition and fees, you can take a deduction you pay for tuition, but usually you're going to want to pay the credit, which I'll go over in a minute. The credit, or not pay the credit, you're going to want to claim the credit. If you can claim the credit, it is most of the time going to be more beneficial than claiming the tuition and fees deduction. So you're taking all these above the line deductions. They're called above the line deductions because they're above the adjusted gross income line. And you're subtracting them from your income right here to get adjusted gross income of, in John Doe's case, $76,754. Now we go to page 2. This AGI transfers over to the top of page 2. And then John Doe has the option. He can either take the standard deduction or take the itemized deductions. Whichever is higher would be the better benefit because it's a deduction. And you want a lot of deductions. So, since he's single, as you can see over here on the left-hand side, since he's single, his standard deduction is $6,100. He filled out his Schedule A, which is the itemized deduction worksheet, and it showed that he has a total of $12,423 in itemized deductions, so he is obviously going to want to take the itemized deductions rather than the standard deduction. So we take that $12,423, put it on line 40. That is subtracted out of the AGI to come up with this amount right here, $64,331. We then take the personal exemption of $3,900 and take that out of the $64,000 to come up with taxable income of $60,431. This is where we figure the regular tax. He's got $11,035. It's not always going to be this simple. I'll try to explain this, but if he's got long-term capital gains, it throws a huge wrinkle in the tax, for instance. But he's got $60,431 of taxable income. Now we are on a system that's he's in the 25% tax bracket, but not all of this $60,431 is going to be taxed at 25%. The first in 2013, the first $8,925 of your taxable income is taxed at 10%. So 10% of 8,925 is $892.50. So we take $892.50, we put that down as tax. Then the next $27,325, which is basically taxable income of $8,926, all the way to $36,250. That's an extra $27,325 is taxed at 15%. Now 15% of that is $4,099. Now, after $36,250, all the way up to past where he is at, somewhere in the 80,000s, that's the area of tax that is 25%. So he's in the 25% tax bracket. So he takes 25% of the taxable income over $36,250, which $60,431 minus $36,250 is $24,181. $24,181 times 25% is $6,045. So if he adds those three amounts up, the $892 plus the $4,099 plus the $6,045, it comes out to $11,035 with a few rounding differences, and that's his tax. Now, like I said, it gets a lot crazier than that when you throw in different types of items that are taxed in different ways, like long-term capital gains or qualified dividends. We can get into that on another tutorial, though. That's not in this one. We go to the AMT next. John Doe's not subject to AMT, but many people are. The Congress made AMT to throw high-income taxpayers more tax, because some high-income taxpayers found out a way to legally to claim many deductions and avoid paying any income tax at all. So the AMT, it was created quite a while ago, and it's got special rules where some income is added back to your taxable income and some deductions are taken away. For example, if you itemize instead of using the standard deduction, and you utilize the medical expense deduction, your medical expense deduction would have to, if you're subject to AMT, your medical expense deduction would have to reach a higher threshold in order to be deductible. Right now, it's at if the amount of medical expenses over 10.5% of your adjusted gross income is deductible. But if you're subject for AMT, it has to be over even a higher percentage, which is not good. There are other things involved too. That's just one very small example. And this has come to hurt a lot of middle income taxpayers too. So it's not exactly how the IRS intended, but they are keeping it, and we still have to deal with it. Of course, John Doe doesn't, as you can see. So lines 46 will subtotal the AMT and the regular, so he keeps that at $11,035. Then we have some credits. These credits are they're non-refundable credits. So if the credits are higher in this section right here than his tax of $11,035, he's not going to get a refund, but he's going to get to avoid paying any of the tax. I'm only saying that because down here there are some credits that are refundable. So if these credits are higher than his tax, he does eliminate the tax and get a refund for the difference. But there is a foreign tax credit if he is paying foreign taxes, like he owns a mutual fund, for example, and he's got foreign taxes he pays off of some interest that he earned. He can deduct that, or claim it as a credit right there, or deduct it on Schedule A, which is part of your itemized deductions. And if he has children, and he takes them to daycare, or someone takes care of them, he can take that amount that he's paying the daycare or the person and use that as a credit right here, up to a certain limit. And when I was talking about the tuition deduction, how it's not as good as the education credits, here are the credits. Here's one section of the credit. This is the non-refundable credit, and as you'll see down below, there's a refundable credit too. But for instance, the American Opportunity Credit is a great credit, a very beneficial credit that you can, a portion of it would be up here, and a portion of it would be down here. As you can see, American Opportunity Credit. And there's a few other credits. There's a lifetime credit too that you can have here. There's a child tax credit. If you have a child a certain age limit, you can take a credit here. There's residential energy credits. If you purchase energy efficient property, for instance, for your house, maybe windows, you can take a credit for that as well, up to a certain limit. I believe they have to be Energy Star, labeled as Energy Star property, but you can usually look it up on the internet and figure out if the property that you purchased is energy efficient. And I'm sure the supplier will be quick to tell you too. Self-employment tax, we kind of went over that earlier briefly. I know that's a lot of these things I can go over in greater detail. This is just an overview of the 1040. So that's part of the other taxes section, as is unreported Social Security and Medicare, additional tax on IRAs. This might be if you take a distribution before you're supposed to. You have to pay a 10% penalty on your distribution, and that 10% penalty will go right here. If you have a household employee, maybe they take care of the cleaning, or they take care of your children, whatever, you have to pay the taxes right here, which includes the payroll taxes, the federal unemployment, and possibly the state unemployment too. That you would file a Schedule H, and you would put in how much you paid them from the W-2 and your taxes that you withheld, and it'll also process the taxes that you owe for unemployment, and it transfers over to line 59A. The first-time homebuyer credit, if you purchased a home back in, I think it was 08, it might have even been 09 as well, you had to pay it back. There's a few years where you didn't have to pay it back, but if you did buy a home in the year you did have to pay it back, this is where you would put the $500 yearly payment, which will be added to the taxes. Then you get your subtotal of tax, which will include all these other taxes plus your tax right here. So in John Doe's case, it's $14,312, and then we start chipping away at that tax right here. We have federal income taxes withheld. That's all he has to chip away with. That's from his W-2. And then we have tax payments. If you are this person should have made tax payments because he had some self-employed income, but he chose not to. But if you are self-employed, or you have partnership income, or you have a lot of income that you're not withholding taxes on, you should make payments into the IRS, usually quarterly. You can do it monthly if you want, if that's easier for you. But this is where that would go. If you pay $10,000 per quarter, then that would be $40,000 right here. Earned income credit, this is for people who don't earn a lot of money, and mostly it involves people with dependents, with children. They get a credit on their taxes. Sometimes it's for a fairly large amount, depending on their income and their dependents, that can take away usually all of their taxes and give them a huge refund. That's what I've seen on the few tax returns I've done with people who are eligible for the earned income credit. Here's the second part of the education credit. This is just where if you extend and you make a payment, you would put that payment here. Excess Social Security, this is if you have W-2s from multiple people maybe, and you know you're only subject to Social Security up to a certain wage limit. But if you get wages from 10 different employers, none of them know who else you're employed by and how much money you're making. So they're withholding Social Security on all your wages up to that limit. Now, if all 10 of these people are doing this, then you have Social Security tax. If you're making $100,000 from each employer, you have way more Social Security tax than you should be withheld. And this is where you're getting it back. We're just adding up all these credits. In his case, it's only 6501. We're putting it right here, 6501. And then if this is more than if the 6501 was more than 14,000, he would get a refund, but it's not, as you can see. So he owes $7,811. You can also get penalized on that. If you now most software programs will figure it out for you, but if you pay a lot of these payments in late, you're gonna have to pay an estimated tax penalty on your late payments. See, he still owes $7,800, so he has not paid that in at all. More than likely, I could go into the calculations and figure it out, but he would owe tax penalty on this $7,811 because he still owes $7,800 that he should have paid back during the year. That tax penalty will go here on line 77, and it will add back to this line 76. There's also other penalties. If you extend and you file after April 15th, you're not only going to be subject to the estimated tax penalty, but if you haven't paid everything in, you're going to be subject to the late payment penalty too, because even though you've extended for 6 months, the IRS still requires you or expects you to make the payments, all your payments, by April 15th. So any payments you made after that date, they're going to throw more penalty at you. And then the big penalty is if you don't file at all. There can be up to a 5% penalty on your tax due if you don't file your tax return on time at all. So there's a few different penalties involved that can create kind of a big tax burden for you if you're not careful. But that's just kind of a grand overview of the 1040 tax return. You'd want to sign it and send it off.